Today's episode of Market Talk is brought to you in part by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And good afternoon. Welcome into Market Talk Day 2 from the Farm Progress Show here in Decatur, Illinois. I'm your host, Jesse Allen. Thanks for joining us here today. MarketTalkAg.com, that's our home on the web. MarketTalkAg.com is where you can find us. Facebook, Twitter, Instagram, all of our social media links, of course. And you can also find all of our streaming sources there as well. MarketTalkAg.com. Well, a third straight day down in the grain markets. Here to talk about it, our good friend Mike Zuzolo with Global Commodity Analytics joins us for another Wednesday afternoon. And, you know, Mike, I'm not going to attribute this to the fact it's Wednesday, sir. I think it's just a matter of the fact that it's just a third straight down day here in the market.
These are the guys that are controlling everything right now, Jesse.
The Bulls and the Bears. I love it.
The two Bears. The Bulls aren't even around anymore. It's just two Bears now.
Yeah.
This latest issue with the hurricane is, I think, part of a bigger issue with the market transitioning out of that supply weather-driven model that we've been talking about all spring and all summer long. We're now expecting the supply to at least be average to above average. And now the market, especially given the speed at which we've gone down, this is real reminiscent of times when the market is worried about demand and it goes back to seeking out that demand by lower prices. And Hurricane Ida did nothing but hurt or damage the prospects of putting a stop to that because, A, it was our demand portal when 60% of your grain goes out of the one spot that has seen one of the worst hurricanes in probably history when it's all said and done, the history of our country when it's all said and done. The other factor is that I had put a lot of reliance upon the September contract when we went into delivery. And it has done exactly the opposite in most major part, I think, Jesse, because of Hurricane Ida shutting down the Gulf of Mexico. And so the cash bids, it's kind of like what the hurricane did to the Mississippi River. It made it go backwards. So the cash bids went backwards, led by the Gulf of Mexico. And we've seen 40, 50, 60 cent drops in basis at some areas of the river, like Savannah, Illinois, Cedar Rapids, Morris, Illinois, Cincinnati, it's just been a big hit. So the issue of whether the 660 or 640 cash price was more justified than the 550 cash price on the board, that was completely destroyed, in my opinion. That's why I think Ida is an important feature. And as you see in this monthly continuation chart, two big things to look at here. We have broken the backbone of this chart now on a monthly close. We did it just by a hair when we closed out August, and we went down below the 531.5 low on Tuesday, the last day of August. We were able to get back up above it, and so we held the trend line on a closing basis. But when we came back in on Wednesday to start the month of September, we reaffirmed that trend line, which used to be support, notice the opening is also the high. Now we've got that trend line being tested as resistance and confirmed as resistance as it stands right now. So we have a lot of, and this is point number 1A, I guess, we have a lot of air below us now by breaking this trend line. Not a lot of support until you get to that 470, maybe even 460 area. You're talking about the highs from December of last year, the lows of this January, or going back to the highs from 2019. The other point I'd say to you on this chart before we jump it off the screen, notice what happened back in 2006, 2007, 2008. That's your demand market. I want to say that we're heading towards a demand market now with this price break that we're seeing, but it's way too early to say that, because what you want is a nice steady incline like we had in 06, correction in 07, held those old highs from 2006, and then went up the flagpole in 2008, more of a weather market type environment. But it was overall a demand market that led us there. Why? A, we had tight supplies, and B, we had a weaker dollar. And so we're not there yet, but that's something to be watching for as we go down and test some of these old lows, or excuse me, some of these old highs from 2020.
Well, I'm going to stay on that track here, Mike. You mentioned tight supplies, and I know we got some private numbers about Brazil here today. That safrita crop again dropping a few more metric tons, million metric tons, and then obviously, they get ready to go to planting season down there again in the South America, and they're waiting to get in the fields here, and maybe having some weather issues already again. So, I mean, we think about that realistically. If we go down and test some of that 450, 60 range, can we stay there for that long, just with how tight our supplies are, and still some questions about what we're going to have for yield in the U.S.?
Yeah, I'm inclined to say not, Jesse, and I'll tell you why. And this goes to this new phase of the market I think we're entering into. I think the trade knows that we're very long with funds at this point in the agriculture. The Federal Reserve just got done talking and said they really aren't worried about inflation. And actually, their charts that they released during Jackson Hole and since are showing that they expect inflation actually to go back down by November. So that caps the idea that the funds will stay in the commodity. So that's point number one. Point number two is the idea that we're going to get an early harvest. We're going to see, I talk to clients in Kentucky, Indiana, and we out here in northeastern Kansas. Unless the weather really changes a lot, we'll be running in a week to week and a half because this stuff has dried down so quickly. And so we're going to have a transition from worrying about getting enough rain to we're going to actually be seeing combines in the field and corn getting shelled. And I think that's going to be really putting a lot of pressure on the longs to want to jump back in with harvest and new supplies coming on. And as you say, new planting coming on in South America. The third thing is the USDA report. They just released today that they are now going to look at the acreage all over again. I'm really nervous about the soybean acres. I think those soybean acres could still go up based upon what we dealt with back in March. So I could see it very easily that we go into this really nasty looking price action, but we get out of it really, really fast and we put an early low in place. And so a September low or an early October low would make sense to me at this stage of the game, especially, and this is the key, and this goes back to that monthly corn chart, what I talked about in 06, 07, 08, especially if the dollar remains tame. If the dollar doesn't see the need to be bought as a safe haven, I think that demand market can come together. An additional leg lower in prices will only encourage the demand. And here's the key. If we have low test weights, if this weather did clip the bean yields, which I am hearing in some guys' backyards in Indiana and Eastern Illinois right now, and Ohio as well, the states that everybody's counting on, if we do see these yields get clipped by test weights or missing beans in pods, then the demand side is going to say, that's the biggest crop we're going to see at this point, especially if the USDA lays on more acres early. So that's kind of why I want to hedge. I want to get these hedges on the books because I broke my trend line, I broke my backbone, and I've got these issues out here that make sense. It's worth keeping the risk management side of the account covered because we could still have more downside. And why lose this kind of profit margin when you still got a good profit margin to get after?
Well, when you talk about a low here in September, October, historically as well, we make harvest lows typically. So this is also kind of that time frame where we could see, some of that low price action. And another thing too, ethanol dropped again today, and I think that also had a weight on the corn market and maybe a little bit into soybeans as well if we're talking biodiesel.
It did. I think that's an excellent point to make because this all goes back into seeking out that demand. We've fed the bear with those ethanol numbers because we had literally a weekly record in gasoline consumption. We needed almost, I think it was 23 million barrels, if memory serves me right. Yeah, 23 million barrels a day we needed for distillates and gasoline consumption this past week. That was a brand new record, all-time record for the week on a weekly basis. And yet we saw ethanol production go down by 3%, and stocks only drop like 0.5%. So I still think the corn's not out there to be had because we're still seeing the market bid up pretty well in the ethanol side of the equation with the crushers. But the market doesn't care about that right now. I think it's exactly what you said. That's the perception, is we're losing demand in ethanol. And I think it probably goes in line with the question mark about ethanol in the big picture with this big fiscal stimulus bill and this new green climate bill. and China's update on their hog herd. And that hurts the meal. It hurts the ethanol, the DDGs, all these things. The market kind of wraps up together. So I think they're throwing the baby out with the bathwater in a lot of cases, Jesse. But really, when it comes right down to it, that's what risk management's all about, is hedging, defending your hedges, and having a back door in case you're wrong. Because that, I always go by the mindset that I'll be glad to be right 60 or 70% of the time. 30 to 40% of the time, I'm hoping I'll be wrong. So that's why I always kind of try and have a back door.
Well, talking about the soybean market as well, I know you mentioned that maybe we clip some acres with soybeans. It's going to be interesting to see what we have from USDA if they're looking at acreage again and what we end up getting out of the field. But, we're getting some of this downward pressure in the soy market as well. What are some things you're watching in regards to soybeans specifically here as we work through a couple down days in a row?
Yeah, I could see the soybeans flatlining and making the low actually first. Two reasons for that. Number one, they were down 15% on the month of August, and soft red wheat was actually up about 3 cents for the month of August. Corn was only down about 3%, but soybeans lead month were down 15%, and that's not even including the highs that we made right after that report. And so here we had soybeans had a really pretty decent August report. And all we did after we made that high of 1466 was go essentially straight down after that. So I think the soybeans have the technicals and the percentage losses factored in for whatever the yield may be and the rains that came. Second reason is I'm seeing the meal trying to still find a base, still present some upward bias, still maybe give some buy signals. And the crush margins are now back around $1.15, $1.20. That's really good crush margins for soy meal. So I could see where the meal and the technicals would give the beans more of a sideways look, but I'm not going to recommend buying into these beans until I see that September report to see if USDA does pile on more acres. If they don't, I may be jumping back in on the long side of beans right after the September numbers come out.
On the wheat side, it feels like wheat's just been drugged down here this week by the row crops. And I know we got some cuts and stats, Canada numbers, but what's your thoughts overall in wheat, talking Chicago, KC, and or Minneapolis wheat?
Yeah, I think all three of them are kind of running in the same mindset, except that the hard red wheat continues to try and get towards the soft red wheat. We got within about a penny of that in the September against the September. It'll be interesting when Sept wheat goes off the board, whether hard red wheat actually goes premium to soft red, because that would indicate that the hard red wheat supply is smaller than what the trade maybe was thinking when the last USDA report came out. So between spring wheat and hard red wheat, we may have a wheat market that is ready to try and buy some acres because where supplies are tighter. So I think the wheat market's very well adjusted. It's in good shape from a fundamental standpoint, and it's very fairly priced because, as you say, it's been pulled down by these other commodities. One thing that's really key about this too, Jesse, is when we talk about the wheat, it was the first one to go back to a carrying charge where the September premium was pulled out and pushed into the December contract. And we went from an inversion to the carrying charge, which is historically a pretty negative bias in the market. Well, notice what corn and beans have done now, even with the tight September and old crop stocks. We've got a carrying charge now in corn and soybeans. So once again, wheat kind of shows us that it is the leader when it comes to the mechanics of this market.
Mike, let's talk the protein sector today. That was the one bright spot on this Wednesday. Cattle and hogs looking good. Looked like hogs led us a little bit there over cattle today. Let's start with just that hog market briefly. What are your thoughts there as we've gone another week? Now we're into September officially and looking to maybe find some upside momentum in hogs, apparently.
Yeah, we're going to try. It's probably going to be tough because I think the demand side of the equation, the consumption side of the equation is going to really taper. I think these higher prices that are kicking in September, they're going to be felt by the consumers. I think you're going to, as a fund or an investment person in their investment mindset in the livestock, I think you're going to have to rely more upon the equities markets at this stage of the game, Jesse. So I think the hogs did find some support off of the Chinese attaché, the U.S. attaché out of Beijing, talking about the Chinese herd for hogs not being rebuilt nearly as quickly as they had thought. And so I think this is supporting the idea that we're going to keep exporting the pork out the door. That, I think, is probably Thursday's bright spot in the weekly export sales as we see a continuation of the exports in pork. Similarly, with the beef side of the equation, we heard Argentina is going to keep their export caps in place to try and curb their domestic price of and inflationary prices of beef in their country. That too, I think, was felt and picked up by the market. And it was nice as a kind of a finishing touch on Wednesday to see the central stockyards numbers come in. And we got into the mid 120s for fed steers, which is a really needed place to be, especially since we're closing out the summer grilling season this weekend. So my assessment is that we've fallen enough in the fat cattle. We probably have more downside in the feeder cattle, just seasonally, and the premium in the feeders versus the fats. The hogs, we've had enough of a rally, but I could see them maybe trying to trade up a little bit more in the first half of September. But then after that, maybe it gets a little bit more difficult with the seasonality there as well.
Yeah, and you mentioned that seasonality, and you mentioned, this weekend with Labor Day, and obviously, I think we touched on this last week with beef cutouts starting to kind of chop around and fall lower, and we're still kind of seeing that trend continue. We're not skyrocketing $6, $7, $8, $9 a day. It's more like, hey, we're maybe up 50 cents to $1. We're maybe down 50 cents to $1. We're really starting to chop around with those cutout numbers, and I think that's a big key as well, especially on the beef side.
Yeah, and I got my price break. We went from that 127 down to about 120, and that's what I was looking for, was just to correct this market, make it wake up to the idea that the cash market wasn't playing ball with the futures. And I think the futures guys respected that in terms of wanting to adjust and test the downside. So the fat cattle market looks a lot more cleaned up to me, and I'm really close to wanting to pull some hedges in that. I did not like China's economic data, their manufacturing PMI. Their new export orders, for instance, were at the lowest in like 14 months. It was well below 50%. And, we've got some, they go into this mindset in Asia right now that they're going to have zero COVID and have a zero tolerance policy of COVID. They're going to lock down so tightly because they want zero COVID cases. That's going to do nothing, in my opinion, economically, than just kill consumption, because I don't know if you can get from here to there with the consumption or with the virus that we're dealing with, and especially the Delta variant. And so it really strikes me as odd that a lot of these Asian countries are going to a zero tolerance policy. Australia, another one. These are just going to hurt your consumption and keep your restaurant business down, keep your livestock business down, keep your kill capacity down. So we got to get through this. So I'm still a hedger at higher levels, but I feel pretty good about the cattle being more at an equilibrium price.
Mike, any other final thoughts you have for us today here before we wrap it up from Decatur, Illinois?
I think that'll do it, Jesse. We'll just be, next time we talk, we'll be right around the corner of that WASDE report. So please get out there, get your pencils, your pens, and your paper and calculator, and get some work done on your marketing and elevate it. Get it locked down before you get out in the fields, because that September 10 report is right around the corner.
Very, very true. And if producers need some help, I know they can reach out to you, Mike, on your website. You got that free trial. We always talk about that. And a lot of the great research that you have, it's available through that free trial.
It is. Go to globalcomresearch.com, globalcom with 2 M's, research.com. Today in the midday, I sent out my updated hedge recommendations for all the commodities I work with, so that everybody knows where we're at and the recommendations. And I think I don't think it can do any harm to try a trial out here and see what I can offer, and maybe even answer a couple questions for your specific operation.
I will say this before we wrap. I didn't catch the gentleman's name. He was an older gentleman wearing a Tennessee Volunteers hat yesterday here at the Farm Progress Show, and I'm walking through one of the tents, and he stopped me and he said, "You're Jesse, you're Market Talk. I see you with Mike Zuzolo all the time." Now, I didn't catch his name. I'm thinking he might be one of your clients, Mike, but either way, that was kind of a fun, and it was like, oh, hey, thank you for listening to the show. So that was really cool.
You're doing a great job, Jesse. And the clients and subscribers, I send this to them every week, and they're starting to rely upon it. So my hat's off to you, and I appreciate you having me on.
Definitely. And I'm guessing he will probably see this. He might reach out to you again. I apologize. I didn't catch his name. It was one of those passerby moments. But of course, Mike, we appreciate the time as always, sir. Thanks for joining us. We'll talk to you next week.
Thanks, Jesse.
Mike Zuzolo, Global Commodity Analytics, joining us here for Market Talk from the Farm Progress Show, Day 2 in Decatur, Illinois. Find us online, markettalkag.com. Find more of our coverage from the Farm Progress Show there as well. I'm Jesse Allen, wishing you a great afternoon.